Hello, everyone, and welcome to Leading Indicator, a show by Public.com focused on gaining insight from the world's best macro minds. I'm your host, Kyla Scanlon. We are here with you to discuss the Fed and its possible secret easing of monetary policy. Don't forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews that will help keep your portfolio on track. Today, we are here with Michael Howell, Managing Director at Crossborder Capital, to gain insight into the Fed's monetary practices. Michael, welcome to Public.
Great. Hi, Carla. Nice to be here.
Yeah, I'm very excited to talk to you today about the decision that the Fed made last week, as well as what you're seeing in markets at large. But I want to first start with the insight that you provided the last time that you were on here about the definition of global liquidity, a measure that includes around $170 trillion. Could you explain that measure and its importance to everybody?
Sure. Yeah. I mean, it's very simple, really. It's money moves markets. So what we got to try and understand is that flow of money. And if you watch the money, you've got a pretty good idea of how markets are going to move and which markets are going to move maybe first. And so what we do is we track money flows around the world. We're looking at what central banks are doing. We do a lot of, if you like, Fed watching, but we do that on a global scale. So we're looking at the People's Bank of China, the European Central Bank, the Bank of England, etc., to look at basically what their hands are doing. We try not to read their lips because we know that central banks are not necessarily in the business of telling the truth, but we watch their hands pretty closely. And that pool of money is the amount of money that flows through global financial markets. And it basically lifts or pushes down asset prices according to the strength of the flow.
And one measure that's in there is the collateral pool, right? So could you explain that and the impact that it has on the balance sheet of these banks?
Yeah, I mean, one of the things I think we've all got to remember is that since the global financial crisis in 2008, a lot of lending now has basically been, or the bulk of lending is collateralized. Now, I think that anyone that has a mortgage, a home mortgage, will understand what collateral is. It's basically you're borrowing money against the value of your asset, and that basically now occurs on a very big scale globally, where people are not borrowing against their real estate, but they're borrowing against securities, and those securities are mostly government bonds, particularly U.S. Treasury bonds. Now, what that means, if you think this through, is that if the value of your real estate goes down, your ability to borrow clearly is compromised. Similarly, if the value of a government bond goes down, the ability to borrow against that collateral is similarly compromised. So we've got to be very wary about what happens if government bond yields start to rise. And for those of you that don't know this, if bond yields rise, the price of the bond normally goes down and the collateral is impaired. And therefore, rising interest rates across the term structure, in other words, rising government bond yields, are a bad thing.
And rising government bond yields have been happening for a while now. And so what's the current status of this pool and what do you see happening in the future considering that?
Yeah, well, the pool is definitively going down. That's for sure. And there's a little bit of an offset, which is maybe a slightly wonkish concept to think about, and that is the underlying volatility of bond markets. In other words, how much they're jumping around has actually come down. They've sort of flattened off. They're not spiking as much as they were at the time of the SVB failure back in March of this year. Now, that gives a little bit of respite. So it means that dealers who are using collateral maybe are more willing to extend bigger loans, but that's a small offset. The main point is that bond yields are going up. They've been rising pretty significantly, I would say, since the beginning of July now. I mean, they've clearly gone up through this year, but there's been a bit of a jump since July. That matters a lot because the pool of collateral is being compromised, and that will ultimately mean that global liquidity is similarly hit. And if global liquidity is hit, you're going to see asset markets react negatively to that. A lot of the move that we've seen in markets over the last 12 months have really come through because of rising liquidity. And maybe as you foreshadowed in your introduction, that basically came because of what you might call a stealth easing by central banks occurring around about, let's say, from about September, October of 2022. So what we're seeing now is an offset. We're moving in the opposite direction. There is a tightening going on. It's not because central banks are basically tightening anymore. In fact, it's actually ironically because the bond markets themselves are selling off. And that matters a lot.
And so what do you think investors are seeing? Like, why are bond markets reacting this way to what central banks are doing?
Well, I think that's a really interesting point. I mean, if you for those people that watch social media, there's a lot of commentary recently saying that actually the sell-off in the U.S. Treasury market is all about the strength in the U.S. economy. Now, that's plausible, but it's actually not. It's not correct. What's happening is that if you split the components of the bond yield into two very separate parts. One is interest rate expectations. Interest rates are expectations, in other words, what people expect the Federal Reserve to do over the next, let's say, 10 years, if you're looking at a 10-year bond. That really hasn't changed very much over the last few months. I know the Federal Reserve has pretty much laid down now after the last FOMC that they're going to do higher for longer, and I think that's now established. But actually, the level of the terminal rate, in other words, how high Fed funds gets, hasn't really changed in people's expectations. What has changed is something called the term premia. Now, the term premia, I'll come clean, is a very wonkish concept, and a lot of people will sort of go glassy-eyed when they start to think about the term premia. But the term premia, think of it as a risk premia on holding government bonds. In other words, it covers the interest rate risk over the term of the bond. In other words, you don't know what interest rates are going to do. You can make a forecast, but you don't really know with certainty over a 10-year period what rates are going to be. They may be higher, they may be lower. But that term premium gives you some compensation for the risk. Now, normally that term premium would be about 25 basis points, in other words, a quarter of a percent. At the moment, it's minus 150 basis points, minus 1.5%. That is a staggering gap. And we've got to understand why that gap is there. And the reason it's important to state that is that gap is now closing. So what you're seeing is the term premium at minus 150 basis points, starting to get smaller and smaller and smaller, and it's moving back to zero. Now, in the last few days, there's been a big jump in that term premium, more positively. In other words, it's become a lot less negative reading. And if you think about what drives that term premium, it's basically supply and demand in the bond markets. So if there's an excess of supply of bonds, in other words, the price of the bond will be depressed. And what that would mean is the term premium or the yield of the bond will go up. And so what you're starting to see now is supply pressures in the bond market. Now, there are two principal supply factors. One of those is what the Treasury itself is doing. It's issuing a lot of debt, okay? And that debt is paying for a swelling fiscal deficit. And what we know from the Congressional Budget Office is these numbers are going to blow out over the next few years. So if you take Congressional Budget Office forecasts, and they're an impartial body, as you know, what they're suggesting is that probably in the next 25 years, the US debt to GDP ratio for the public sector will be up at 200%. These are like Japanese levels. These are, sky high, crazy levels. They surely can't get to those points. But that will mean a lot of supply coming on the market. And to sell those bonds, the yield on the bond has to go up. So that's one great concern. Now, there's a little bit of a respite in the near term, and that is that technically the Treasury have been quite clever. And what they've done this quarter, and in actual fact, the coming quarter, the fourth quarter, is they've basically funded through bills, not bonds. Now, what that means is it doesn't put any pressure on the bond, or it shouldn't put any pressure on the bond market. So they've actually been helping us in recent weeks. But nonetheless, having said that, the yield has still gone up. So that's a real danger side. So even without doing a lot of coupon funding, the mere threat of coupon funding is actually causing yields to go up. So that's point number one. And that's really important to understand, because what we know is that the Treasury, or the Biden administration, as I say, is undertaking a major fiscal program right now. And many people have said, well, look, this is equivalent to probably the biggest fiscal stimulus the US economy has had since World War II. That may be slightly over-egging it, but you get the direction. So this is a major factor. And will that slow down in the future with all the mandatory spending that's coming through for Social Security, Medicare, etc., defense spending? This is going to be a big number. Politicians don't like to rein back on spending. So that's a warning for the bond market. Second thing is, what you've had in the background is China and to some extent Japan have slowed down or even reversed their Treasury purchases. And foreign participation in the US Treasury market, which if you go back to time of the global financial crisis was about 50% of the market, has come right down to about 28%. So there's been a big fall in foreign participation. Foreigners don't want to buy US debt, or principally the Chinese and the Japanese, who are both struggling. The Chinese economy, is clearly up against the wall. The Japanese economy is not doing great. They're not in a position to accumulate treasuries in the way they were. What's more, geopolitical factors get in the way. And is China really going to be, bailing out or funding the US deficit in the next few years, given these geopolitical tensions? Answer, probably not. And now you've got the Saudi Arabians playing hardball. They're reducing their treasury holdings. They prefer to buy European soccer stars rather than US securities. And that's the issue. Do people want to have Ronaldo in their portfolios rather than a US Treasury bond?
Wow. Yeah, that's quite the comparison between the two. So we have all this issuance coming to market, and there's nobody to absorb the supply. Is that what you're saying?
Yeah, there are fewer and fewer people to do it. Alongside the Federal Reserve, we know is undertaking a headline QT program, and that headline QT program is basically putting additional debt onto the market. So what you've got are all the buyers in the last few years are kind of disappearing. The Chinese are not there, the Japanese are not there, the Saudis are not there, the Federal Reserve is not there, and what's more, issuance is going up. So this is the problem. This is the problem the Treasury faces. And, at the end of the day, what history tells us is the most important price in global financial markets throughout history is the price of the dominant economy's debt, and that is US Treasury yields. This matters.
Yeah, and it almost feels so abstract though. So if all of a sudden there isn't really anybody to absorb the supply of US government debt, what happens to US government debt?
Price goes down, yield goes up. Now
So
the Treasury,
just
yeah,
yeah,
that's it. That's it. The Treasury can't afford that because the problem they get into
right.
is a knife edge. Because once the interest rate goes up, they're going to have to pay more interest expense, which means more debt. So it's a vicious circle.
Yeah. And that's why you hear these things of people saying that interest expense is going to be so much of government spending over the next
Correct.
coming years. Yeah.
Correct.
Yeah. And going back to the point about the Fed and doing, quantitative tightening, what's the impact to global liquidity there? I know we sort of talked about it, but is that having a pretty direct impact in your view as well?
Well, I think the answer to that question is it's a fairly complex answer, but at the end of the day, what you've had over the course of the last 12 months is the Federal Reserve is doing a public QT. They're actually, as they define QT, that is rolling off treasuries from their balance sheet. And they're no longer holding as many treasuries as they used to. Okay. Now, the key point is that reducing liquidity in the money markets? And the Federal Reserve controls money market liquidity. And the answer is that, having said that, it's not changing because other elements on the balance sheet are compensating. So the point that we've been making is that although the Federal Reserve is publicly claiming, or it's actually publicly true that it's reducing the balance sheet, it's not reducing liquidity in the US financial markets. And that's the key point. So they're sort of moving the goalposts, or if you like, having their cake and eating it, to mix my metaphors. But basically, that's what's going on. And what they're doing is they're finding a number of offsets. Now, the way to view that, if people are really interested, is to look at the weekly Federal Reserve statement, the H4.1 as it's called, and look at the US bank reserves. They have mysteriously flatlined, at just over $3 trillion every week for the last year. Now, that's much more than a coincidence. And as we've been saying, look, okay, we're open-minded about what the Fed is doing, but at the end of the day, if it's yellow and quacks, it's a duck. And what's happened is you've done an awful lot of quacking in the last 12 months, 52 weeks of keeping bank reserves pretty much fixed at this level. It looks like they're being targeted. Now, why are they being targeted? Because we've got, and we know we have, problems in the regional banking industry sector. And the Federal Reserve can't afford to let any of these banks go. So at the end of the day, what the Federal Reserve is doing is maintaining liquidity levels, surreptitiously maybe. You can see the effects of this on the market because asset prices like to go up when there's more liquidity. So it in part explains why Wall Street's been so buoyant. But now you've got another factor coming in, which is the fact that collateral even aside from what the Fed is doing, collateral itself is starting to fall. So, the Federal Reserve is sort of juggling many balls in the air here. And can they keep yields down on the Treasury market while also keeping bank reserves flatlining? And I think it's going to be a really difficult ask.
Yeah, they have it's a very tough job across the board, I would say. And I
Sure.
want to be respectful of your time, so this will be the last question. I have a million more, but so the Federal Reserve did raise their forecast guidance for GDP from 1% to 2% for 2023. So thinking about that, and thinking about this economic growth that we seem to be experiencing, are you still worried about a recession, or do you think investors should worry about a recession?
And well, I think the fact is that look, the Federal Reserve is more or less saying that they're going to keep rates higher for longer. They want to slow the economy, that's for sure. Will they get away with a soft landing? I think the answer is they may. And one of the things is that what we don't know, and I'm talking generally here, and including the Federal Reserve in this, is basically how the structure of the economy has changed, and how much it's become less sensitive to interest rates following the global financial crisis. And I think in many ways you could argue the polarity of the financial system has changed in many ways. And what I mean by that is a lot of former borrowers are now lenders, and a lot of former lenders are now borrowers. So the whole thing has switched around, sort of topsy-turvy, Alice in Wonderland, if you like, world. And the reason that that's important is if you start to think of the yield curve and the inverted yield curve, most people would have argued that normally means recession. But if you've got a situation where corporates are borrowing at term further down the term structure at much lower rates, okay, and they've locked those rates in for 3 or 4 years at least, okay, they're not worried by rising policy rates at the moment. Whereas those other corporations in the US who are sitting on big cash piles, particularly the tech stocks, what you're finding there is that they can invest at money market rates at very high returns. And so what you're getting is a net cash flow into the corporate sector. So it doesn't mean it's necessarily recessionary right now. So the Federal Reserve may have to squeeze a lot more if it wants to create a recession. But there's no question that cyclical parts of the economy are slowing down. What I question is whether this is yet recessionary. I'm not sure it is. But, hey, at the end of the day, what matters is the flow of liquidity. And the flow of liquidity, to my mind, is currently flatlining because of this collateral problem. It could get worse. We know that. But you've got to really start watching the bond markets and make sure the bond market doesn't sell off, or at least the Treasury has got to make sure it doesn't sell off. And they're
Yeah.
going to do a lot to try and do that.
Yeah, the bond market is definitely the oracle of the future, it seems. Thank you so much, Michael. This has been so helpful. Where can people find your work and interact with you?
They can find, we've got a website, which is crossbordercapital.com. We've got a Substack, which is called Capital Wars, which is a view to the future. It's all about capital wars in the future between the US and China and Europe and whatever. And there was a book I published on the same title. And there's also a Twitter or X handle, which is called @CrossborderCap.
Thank you. Thank you very much. Yeah.
Great. Thanks, Carla. Nice to be on.